Welcome back. Well, markets rallied, of course, after the Fed announced last week that inflation had eased over the past year and hinted towards rate cuts during 2024. Our next guest expects 6 rate cuts begin as early as March. What could this mean for markets that are near historic highs? Let's welcome Andrew Brenner. He's a familiar face. He's also head of international fixed income at NatAlliance Securities. Andrew, thanks a lot for joining us. Tell us why you believe 6 rate cuts are coming from the Fed, beginning as early as March and stretching through what period of time, Andrew?
Well, Paul, thanks for having me as always, and happy holidays to you. Our view is that the economy is slowing down, that inflation is dropping dramatically, and even though employment still remains strong, there's no reason for the Fed to keep rates as high as they are. So we think 4% is a good level for Fed funds. That's 150 basis points. That's 6 rate cuts between starting in March and ending in December of next year. So I think 1 year from now we'll be at 4%. You could be a tad lower, but that's our view right now. And we saw Powell last week, and we saw him 2 weeks ago, as well as Jefferson, try to let you know that higher for longer is no longer their mantra, and that they're scared of being high for too long. So we think that they're going to start easing faster, and even though the markets might have gotten a little bit ahead of them, and you saw Williams come out on Friday along with Bostic, you had Goolsbee on Face the Nation yesterday, and again this morning, and Mester interviewed in the Financial Times, we're tending to ignore all those people, and we're just looking at what Powell thinks and what Jefferson thinks. And we think that they're going to be easing next year more than the 3 that they predicted.
That was my next question. You tossed out lots of names there of Fed members who are speaking in one forum or another. But one of your adages is, we've said all along, listen to Powell, listen to Jefferson, and ignore everyone else. Why so?
Because they run the Fed. There's no question about it. Jefferson being the vice chair and Powell being the chair, they determine what we're going to do. I mean, can you imagine Bostic coming out on Friday and saying, oh, we're only going to have 2 rate cuts to the end of the year? 11 people all voted. It was 11-0 in the Fed meeting. Powell was very clear that they were talking about rate cuts. They are thinking about that, and the market picked up on that. So we think that Powell, who's more of a businessman than the academics at the Fed, has a very good handle on where the economy's going and where Fed funds should be. And I think he's been very, even though he's made some mistakes along the way, certainly in early 22, the Fed should have been raising much earlier, probably late 2021. But nonetheless, as to where we stand now, we think the Fed's going to ease. We think rates are too high. And if the Fed continues to keep rates as high as they are, something more will break, more than the banking system that we saw last March. So I think it's a good move.
What happens to bond yields? We've seen a significant retreat from the 5 level to the 4 level in the U.S. 10-year. What happens to bond yields under your scenario?
Well, Paul, I think that we might have moved a little bit too far too fast. And the reason we're not backing up right now is because you have $6 trillion on the sidelines in money markets, which is a record amount. That money is managed by a lot of professionals, and that money has to get into the fixed income market. So even though we're backing off right now, as I look at things, 10 years off 5 basis points today, we think it will probably find support at the 200-day moving average, which is 402, 403. So we think a little bit of backup, but we think next year we're going to be, as we said this morning in our commentary, in a 100 basis point range. We think 330 is achievable, but we still run the risk of getting back to 430. So 430 to 330, we think we're going to hit that by the second quarter of next year.
You say that given a tightening of credit spreads, do you see equities doing better? Explain.
Well, equities are corollary to where they can issue debt. So credit spreads are leading the category. Credit spreads have been tightening for the last 4 or 5 months on the idea that credit is in good shape, that there's been a lot of change as to what high yield looks like. High yield used to be more single Bs, now it's more double Bs, and all those spreads come in. And as those spreads come in, it means the value of equities are higher. And we're seeing slow movement into the Russell 2000. We've seen an improvement in banks. So we think that equities are going to continue to run. This morning, Goldman upped their target for 2024 from 4,700, where they were, which was where we are right now, to 5,100. And most of the people we follow are in the 5,000 to 5,200 camp. So we think equities are going to do better. But, Paul, it's not a straight line. They easily could have a reversal. We could have a 10% correction. But the way I see it, this Friday's number, which is on a half day because of the holidays, this PCE number could be a real big surprise, a positive surprise for the markets. We looked at where, the expectation is 2.8 versus 3. Jeffries, which is the most aggressive, is at 2.5. If you get a number like that, we're off to the races. We're going to be down to 374 10 years on the way down to 350 and in 3 3/8. So that's what we're thinking, but we don't think it's going to happen that quickly, and it's going to be back and forth.
The PCE deflator, often referred to as the Fed's preferred gauge of inflationary pressures. What about 2.0% inflation, Andrew? When does it get there in the U.S.?
I think it's already there, Paul. I think if you look at it over a 6-month time frame, a lot of the numbers are already showing that. Yes, there are some numbers that are higher. The CPI year over year was 4%. But you know what? We don't think that's representative of where real inflation is. And we think real inflation is already near the 2%. If you look at the PPI numbers, the PPI numbers are like showing deflation. So I think that I think that deflation is making a move. And while there are a lot of lagging things like rents and housing prices that really don't get marked day to day, and they're keeping some of these numbers higher, we think the real inflation is very close to the 2% level, maybe between 2 and 2.5. And I think Powell mentioned something over a 6-month time frame, 2.5. I think it's actually, with the latest numbers, I think it's closer to 2%.